thanks for taking the time to be here. I know everybody's got, busy schedules, so it's good to see some familiar and some unfamiliar faces in the room. A lot of folks that we've worked with for a long time are here tonight, and it's really kind of cool to see everybody. Everybody knows my partner, Dennis Packard. Dennis has been, this is your 10th anniversary on?
Saturday.
We like to kind of keep a tight-knit little group. Who knows the story about how Dennis and I got together? Anybody? Who does anyone care to know? Show of hands of who cares to know. 'Cause I can. Okay, well here's the deal. So way back in the day, he was with TD Waterhouse, and they were looking for a fee-only financial advisory firm that didn't put business with one of the big brokerage firms. And somehow they came across me and Darlene and our little gig that we had going on at that time. And so Dennis and I started to do joint client work together. He was at TD Waterhouse, and I was doing my thing at what at that time was Puckett Financial Advisors. And so he says, well, you got to come down to Dallas because they're having this really great educational event, and I want you to be my guest. TD Waterhouse is putting it on, and then I will take you out to dinner at the Ocean Air restaurant. And so I was like, well, if you'll take me out to dinner at the Ocean Air restaurant, I guess I'll make a 3.5-hour drive down there. So you guys have probably noticed that I'm not, just the most social guy in the world. So I show up in there and I'm kind of walking around looking, and Dennis just like, he's nowhere to be found. And I'm just getting madder and madder. And, so then I go over to the Ocean Air and he's still nowhere to be found. And so I just leave and go get in my car and start driving back up to Oklahoma City. And it's freezing, and I'm driving up I-35, and I'm just sitting there going, God, I just cannot believe that he blew me off like this. And so about Benton, I picked up my cell phone and I called up, and Dennis answers the phone, hello, and I said, well, hey, what is going on? Where are you? And he said, well, I'm in Edmond. And I said, well, why aren't you in Dallas? And he said, well, did you not get the news? And I said, no, what's the news? And he said, well, TD Waterhouse closed down the Oklahoma City office today, and so I lost my job. And so I tried to jerk my foot out of my mouth. And I was like, well, gosh, I am so sorry that occurred, and how's Carrie, and what's going on? And so I said, well, call me if I can do anything. I hung up, and I just kept watching the white lines go down the road, I-35, where it's real bumpy there. And then I just picked up the telephone, and I called him back up, and I said, Dennis, this is Brian. And he's like, yeah, what's going on?
What are you going to yell at me about now? No.
I was like, you want a job? And he says, yeah. I'm like, well, listen, I have no way of knowing how we're going to make it work. I don't know how I'm going to pay you. I don't know how we're going to do health care. I'm sure that TD Waterhouse had a great, benefits package, but I'm pretty sure that we can do some pretty good stuff together. And anyway, I didn't plan on talking about that tonight, and I do want to keep the talk at about an hour, but I thought I'd share that with you guys. And Dennis has been around for about 10 years. Darlene, our client service manager, has been with us like 13 years?
15.
15. I like to say that Darlene's been with me longer than any woman in my life other than my mom. God love her. That's not to say we get along wonderfully. And Debbie Stanley, who put this entire event on, I think going on 7, 8, 9 years. I lose track of time. I'm sorry? 8.
God, that's
Laura Payne just came on board as an advisor. For those of you who've not met Laura, we have worked with Laura for the past 14 or 15 years, but she's been on the other side as a client doing kind of pension 401k benefit stuff, and we hired her away from one of our clients, and so we're really excited about having Laura on board. She's a CFP and a CPA and just been a tremendous help. So click to the next slide. While we're on things like, the IRS and stuff like that, the SEC and the lawyers love for you guys to read carefully these legal disclosures. So we'll stay on this slide for about 20 minutes so you can read over this and we can all kind of fall asleep. No, but in all seriousness, there's one of these that you can take with you when you leave tonight. But with that said, Dennis, if you'll get into the agenda.
Yeah, so what we're going to cover today, first we'll start off with just a brief review of what happened last year in the markets. Maybe a few headlines of what was some of the big topics last year and what to expect going forward. And then the next thing we're going to do is talk about how we create a portfolio to serve your plan, a plan based on your goals, your time frames, your risk tolerance, your cash flow needs, and how we back up into the what customized portfolio fits you. And like Brian said, most of you have gone through the process of taking that a step further and actually creating a cash flow plan to where we can monitor, are you on track? Are you on track to be able to do what you want, when you want, without any concern of really running out of money at some point? For the rest of you, again, we've made just a base plan. If we haven't gone through that process, we've just taken what we managed for you and said, okay, based on the information we do have and what we've made for you, here's kind of what we see. And everyone, so we've got that when you leave today, we'll hand these out to you. In everyone's packet, there is a questionnaire or a little summary questionnaire in the back, a pretty simple one. If we've done one and there's some changes, feel free to put some of the changes on there and get that to us. And then we'll update it and meet and go over these changes. For those of you who haven't really gone through this process and you're seeing this for the first time, we really urge you to fill that out. Put us to work on this and tell us, here's what else I've got. Here's my Social Security income, what it is now or what it's going to be and when I would take it. And here's our pension income and here's some, what we've got in the bank and, mortgage, all that. And we can tie everything together and really track not only just your investments with us, but just your net worth and look at should there be tax planning based on what else is out there. So we really, put us to work on that if we haven't done that for you yet. And then last, we'll take some Q&A at the end.
I think, or I hope, everyone in the room have been through our investment philosophy brochure that we worked on a lot over the past 3 or 4 years, but it really contains pretty much everything that we'll talk about today. Fact is, I'm 28 years in the business, and this is pretty much everything that I've learned that really matters. It excludes things that don't matter. It only includes things that we know have worked by experience. So I would really encourage you guys to, if you don't have a copy of this, I know that there's a few hard copies that you can take with you when you leave. On our website at alignmywealth.com, the fully updated version is on there. And it may look a little bit overwhelming, but about half of it are pictures and charts. But it's really pretty instructive, and it's not just marketing fluff. It's really what we do, and your investment portfolio and your financial plan are just a customized version of this. So I'd really encourage you to take it'd be a good refresher for everybody.
And that really is what we're doing with your portfolio behind the scenes. What we wanted to show you, though, is take a little step further and show you who's doing this work behind the scenes. Oh. All of you see all 5 of us all the time. We're your team here that's doing the work, and we sit down and meet with you face to face. But this is just part of the team that's working behind the scenes as well. And so we want to kind of give you an idea of what else is out there, what it takes to really implement. This is how to do it. This is who implements it. And we've got, over here, you've heard us talk quite a bit about Forum Financial, who helps us with a lot of our back office. I know you can't read this, but over here is the investment committee. We work with their investment committee regularly to discuss our portfolios. Here's what we're looking at. Here's what we're thinking about doing. What are your thoughts on that? We'll listen to what they're doing on theirs. And then both of us together work with Dimensional to look at, have them do some research on our thoughts and come back to us with how that looks. They've got insurance if we ever come across something with long-term care, life insurance, something like that. They've got Howard. We just give him a call, so that's a great resource. And one of the other ones here is what time is it? Still, right now, we've got 2 dedicated traders right here working on your behalf that are sitting there staring at a screen right now, looking at all your portfolios, trying to see, looking at should something be rebalanced? Did the cash come in that we need to put in instantly? That came in today. They're letting us know, okay, we saw this check come in. What do we need to do with it? You want us to go ahead and put it in the portfolio, or this rebalance came up, here's the tax, do you want us to do that or not? And so that's who's monitoring this data. We always talk about rebalancing, and as you see, we're meeting you face to face. The team's doing other things, so who's doing that? And that's where that's from. And then here we've got dimensional on this part right here. You've got dimensional funds as a heavy part of your portfolio. We really use them a lot for research. They've got some of the best data set out there, so we can give them some ideas of what we're looking at. They feed us, here's the latest research, here's what you guys might want to look at. And then we've also got that with a company called Bellhaven, if we're looking at anything on the municipal tax-free bonds. They help us a lot of the research and how to best implement it for client portfolios. And the main thing, again, this isn't everyone, but I think we're going to point out is, so everyone's working on you. On this page right here, there's 9 certified financial planners, 5 CPAs, 3 attorneys, 8 PhDs, and 2 Nobel Prize winners. And so we've got a good group of people just to bounce ideas off of and make sure that we're doing the best job we can all the time.
I honestly think, and I'm not just blowing smoke, that we've got some of the best, smartest clients around. I just feel so lucky. But I know that you're smart enough when you read through something like this to say, well, there's no way that Brian and Dennis could do all this. So these are just ideas, these are just concepts and principles, and like any idea, it's got to be implemented to add real value. And so it really takes a lot of people to really help us implement that in the real world and make it happen for you guys. So I can't tell you how much help all these people are. You never know when one of these issues is going to come up, where we go to the guys at Bellhaven who know exactly what's going on, in Puerto Rico right now, or somebody needs a real complicated insurance and estate plan, and so we can tap into guys like Howard Kite and Norm Mindell. And I think a lot of people in the room have met these guys. This isn't like, if you're at, and I'm not saying it's right or wrong or whatever, but at a big brokerage firm where they've got all these people in the back office. I mean, we really work hand in hand with these guys. Day in and day out. Like I talked with one of the guys at Bellhaven just yesterday on a case that came across our table. We talked to the traders almost every single day.
Norm and Jonathan were here last time.
Jonathan Rogers has come here to talk, and I'm sure you could, it's pretty obvious the brain power that kid's got is amazing. So, in any event.
Yeah.
Okay, fun stuff. I've warned a lot of you people that we really don't have anything positive to say about the markets, and they didn't really cooperate today. You'd think they'd be a little bit nice when we're trying to have a cordial client event, but it's been pretty tough in the markets. Last year, the market ended up about where it started, with a lot of ups and downs. And this year, I didn't really calculate it today, but I think the S&P's down maybe around 7.5%, 8% year to date. It is what it is, and we got to kind of play the ball where it lies. We got to be adults about it. We can't be kids about it, and we can't ignore it. We just got to continue to, people have asked us, well, what are you doing? Are you heading to cash? You don't look like you're too uptight about it. Look, 28 years we've been through this before. This is not our first bear market. It's never fun. I shouldn't even have said that. This is not really a bear market. A bear market typically is defined as a market that's declined 20% or more. We haven't had that yet. I'm not forecasting anything. I don't know whether it's going to turn into a bear market. You don't know that you're in one until you're in one, or maybe you look in hindsight and say, well, yeah, that was but if we are in one, some of the only things I can tell you is it's going to, I look at some of the faces in the room, we've been through a few of them together. It'll go deeper than you want. It'll be more painful than you want. The media is not your friend. They're going to be talking about this is the end of the world. They're down and they ain't coming back, and it's only going to get worse. And one of the reasons, there's a couple of reasons that we're not freaking out. Number one, I might just use an analogy that I thought about, and that is, as I look around the room, a vast majority of people, how many people in here have been clients of ours for more than 10 years or more? Hands up. So much more than half of the room. So we went through the greatest stock decline that anybody in this room. We went through the greatest stock market decline that any probably breathing person that has any money has been through from 2007 to 2009, right? And we went through that together. And if the analogy I might use is that we kind of went through a plane crash together. And if you're going to go get on board an airplane and you had already been through a plane crash, I mean, I bet you'd be pretty nervous, even though the odds are like maybe 1 in million or 1 in many millions that plane, you know, the plane's not going to go down again. You're probably not going to be that unlucky, but you're probably still going to be thinking about that time you went down, you know. And so you're, you know, I would think you're just going, I can't take, and I can't tell you how many conversations I've had with clients. I'm not going through another 08 again. I cannot take it. Not at this point in my life. I'm not doing it. And I get that. And you're just kind of like, I guess the only thing that I would say, I think that it is our job, and I want to come across as with all the kind of respect and love that I have, but I don't think it's our job to freak out. If I were on an airplane, you know, I've been on airplanes before, and so have you. When there's going to be some turbulence, right? And the pilot comes over the radio, so I might be coming over the radio right now saying, listen, folks, this is likely to be a rough flight. We may not have our ordinary beverage service on this flight, okay? Now, if you need a strong drink, we can accommodate you. Just punch the service button and we can make that happen. But otherwise, please stay in your seat with your seatbelt fastened and don't go mingling around the cabin. We've got this. We've done it before. We will get you to your destination safely and on time. I'm not saying it's going to be a barrel of monkeys, but I am saying that we're trained, qualified, and we'll get you there. And so if you can kind of keep that in mind, I sort of think that it's our job, even if people are losing their cool, even if the media is squawking, I think our job is to be objective and logical and run our strategy that we've agreed upon together as best as we can. If what we go through today, and we're going to talk about risk, if you think your portfolio is too risky for you and it's disrupting your sleep or your life, then get in to talk with us, and you know, we'll modify that portfolio to get it right for you. But does that make sense to most folks? And again, it's not fun. I mean, I hate losing money, and I especially hate losing other people's money. But no panic, no sell, no lose. So what we're going to try to do today is kind of put things in perspective so that there's no surprises, and hence no panic, and hence no sell, and hence no lose.
Let us do the worrying for you. I always say before 2008, Brian and I had the same hair color. So we'll do the worrying for you. Let us do it. So here's 4 of the topics, the main topics in the media last year. We're going to hit 3 of them. One of them was grease. That's always going to be a topic. It's never going to go away, so we're not even going to talk about it. It'll be here every year from now on, probably. The first one, though, unfortunately, everyone here is all too familiar with, and this is going to hit. You know, if you're in Oklahoma or Texas, we all know what's going on with oil. We've seen the number of U.S. rigs decline by over 60% in the past year. If someone either has been affected or knows someone that's been affected by this downturn, my little brother was recently laid off. So if anyone needs a young, hardworking petroleum geologist, let me know, and I'd be happy to send his resume to you. But it's not all bad news. It's going to affect us here, but I was watching Boone Pickens speak 2 days ago. I'm going to steal, this is about the simplest way to say it. He said, this is bad for producers and good for consumers. And luckily, there's a lot more consumers than there are producers. And that's really the way to think about it.
I mean, that may fall on deaf ears with the people in the room that may be involved in oil, and I can't emphasize enough. I mean, I know this is affecting right here in our state. This is our tribe. We got a lot of friends and loved ones that are involved that are being hit hard by this, and I don't want to minimize that. But Dennis is right. There's pros and cons to this oil thing, and on the bright side, it really, I don't know where Laura ran off to. I can't see anymore. I used to worry about when I do one of these talks about what I'm going to say. And today I was wondering whether I got the right thickness of glasses because I got 2 pairs, or whether I got my batteries in my hearing aids. But and now I forget what I was going to say. But no.
Oh boy.
Laura comes in and she's like, she couldn't wait to show me something this morning, and she comes in and she showed me she got like what, $1.16 a gallon gas or something. And so, you know, for those of you that are not directly involved in the oil business, I think there are two primary things that we need, and we could spend the whole day talking about this one topic. So, but I think there are two key things to kind of keep in mind, and that is that, you know, at the current price of $30 a barrel, on an inflation-adjusted basis, the price of oil is the same as it was when the Shah left Iran in 1979, when I was a sophomore in high school at Edmond High School. Okay, number one. And number two, at $1 a gallon, this is like the largest tax break, if you will, for the middle class in America in the history of the planet. I mean, you know, enjoy it while it lasts, because it's not gonna.
The next big topic has been China. What you got here is their GDP growth. I mean, they were growing at 10% a year back in 2010. They're down to 6.5% roughly projected going forward. Really what I wanted to point out on this is that, you know, once this came down, we've seen a pretty sizable decline in the China stock market to reflect this. But you've heard us before talk about the market's based on expectations going forward, not what's, you know, what you think. I mean, 6.5 is a good number. The U.S. would love to grow at 6.5. We're at 2. But they're going at 6.5 and their stock market declined. Think about if the U.S. came out and said, okay, we're having 6.5% growth next year. It'd be the largest bull market we've ever seen. And so think about, so that, you know, now the China market has corrected to where it's declined to where it's ready for 6.5% growth. If it's 6.5, it'll probably do really well. If it's 7, it'll do great. So it immediately reflects the prices of the news we know going forward.
Well, hang on, before you leave that slide, I think there's a couple of other points, not to state the obvious, but we're talking about a country that's a controlled communist country. So they've proven they have no problem cooking the books and publishing false numbers. So you know, whether it's 10 or 6 or whatever, I mean, I don't know. And you know, there's all this talk about how powerful China is and stuff. I mean, they just came out today and again devalued their own currency. So I mean, there's a lot of things that really kind of make me think, well, how real is this? But a kind of a picture is worth 1,000 words. And so if you take a look at this, I think this next slide, if you will, Dennis. Many of you in the room have seen this chart before. This is our globe that we kind of think of the world in. This is a map of the world. I see Carol Swink is over there going, well, I just traveled the world and it doesn't look like the world to me. But no, and I do want to see some of those pictures, Carol. This is based not on land mass and not on geography, but it's based on market capitalization. In other words, where is the money at? And the market capitalization of all publicly traded companies in China is a mere 3%. So you've just got to ask yourself, how material is China really? Or is it just something for the media to feed on and feed on and feed on and say, this is the next end of the world? You know, which last year it was Greece, which I'm going to have to kind of point it out. Remember, this is Greece. And it was the end of the world last year, but it turned out not to be the end of the world. And I suspect that the same thing's going to happen with China. It's going to turn out not to be the end of the world. But anyway, I think that kind of that may kind of put things in perspective. I don't know how long the China story is going to go on. I'm sure it'll continue to go on for quite some time. But a picture speaks 1,000 words. That's how big, you know, their market capitalization. Oh, I would make another couple of points about this. Looking around the room, and I got to be careful about client confidentiality. But let's say we're going to go over like the model align 60/40 portfolio. We're going to walk you through how we build that portfolio. But if you think about that, you've got 60% of your money in stocks, you've got 40% in bonds. Suffice it to say that we're really, really conservative in our bond allocation. We don't buy any, nobody owns any junk debt or junk bonds, okay? And on the equity side, at the most, a balanced 60/40 portfolio is going to own like 1.7% in Chinese stocks it's not going to derail your retirement plan, even if all the bad stories about China come to pass. So, again, how material is it to you? I would suggest that it's not hugely material. So,
I guess the thing is, we pointed the arrow at Greece last year. China this time, it's going to be to pick where it's going to go next year.
Something. I mean,
there'll
be another apocalypse de jour next year or next quarter. I don't know what it's going to be, but it'll be something.
The next big topic has been rising rates. It's been a topic for 9 years going now, pretty much, but it's been expected going forward. We actually had one just recently. But the myth is anytime rates go up, bonds go down. All of them are going to go down. You're going to lose money in bonds. Here we've got the last 5 periods of rate hikes. And you see that's really not the case. And 4 of the 5 periods, bonds increased in value. In each of the 5, stocks increased in value. And to kind of bring it home and make it more real to what you've got now, we just had a rate hike on December 16th of last year. And so if you look at your core bond portfolio, all the bond holdings, on average, they've gone up about 1 3/4% since December 16th already, within a month and a half. And the long-term bonds, it's kind of you don't want to, the longer you go out, the more it's going to get hit and more it's going to hurt. We started adding these long-term bonds to your portfolio about in August of last year. And the same time period from December 16th to yesterday, they're up 5.3% since the rate hike. And so that's been one of the better performing parts of the portfolio, even though we've started to have this rate hike.
I might just note, I wasn't texting on my phone. I was just checking this long-term bond allocation that we've recently been taking in 20-year treasuries. Is designed to really kind of support and go up when we have a bad day in the market, and that in fact happened just today. So not that it works every day and not that we're perfect, but the stuff that we're doing in the bond side looks like it's working pretty well. Okay, so declines happen, and I thought it might help to put in perspective the declines that we've seen recently vis-a-vis all major market declines going back to the end of World War II is what I have here, and this is data that was published by the S&P 500.
You'll see that.
But the fact of the matter is that the declines that we've seen, at least recently, are really pretty mild. I would say that they're common as dirt. We see that a 10% or more decline has happened in 53 of the last 70 years, or about once per year. The data is really a little bit uglier than that. Dennis is going to get into a slide here in a minute that shows for about the past 40 years, equities have declined on an intra-year basis to the tune of about 14.5%. The story gets a little bit worse. Declines of 15% or more have happened in 21 of the last 70 years, and what Wall Street defines as a bear market, a decline of 20% or more happens about every 5.5 years, and that's happened 12 times going back to the end of World War II, 1946 through 15. So they happen, but I mean, I guess the point I would make about it is that the declines are temporary, and the advances are permanent. And we'll kind of go over some of the advances. Why would anyone want to hold a portfolio that is you're going to watch, anywhere between 10 and maybe upwards of 30% of the stock side of your wealth decline and make you sick? And really the only reason to do that is the expected return. So we'll go over that as well.
So this is the data Brian just went over and a chart. And I really just wanted you to see this those are numbers, but here's what's really happening. You kind of see, you look at year by year and what investors experienced. And you see, every year there's some kind of decline. Some years much worse, some years not as bad. And then the green bar is where it finished. And so every year you see a decline here. 75% of the time, the market ended up positive. And so another thing I want to point out here is, I do my best not to read the headlines, things like that, but I've kind of paid attention the last few days to see, just based on this, and I saw headlines that said extreme turbulence, unheard of volatility, all these words to make you click on it and go, oh man, what is that? And that's what they're putting on the headlines. So you see, again, it's averaged 14.5 a year. Here's been the past 4 years, 10, 6, 7, and 12. That's been the volatility. It's been less than average. It's been much less than usual. And we've got some pretty good returns in those years too, in the US market. And so even though you're reading that, you're thinking, okay, man, and we hear it all the time, man, the market is so volatile, it's just all over the place. Another thing is that 20, 30 years ago, it was at, the Dow was at 7,000 and 6,000. Now, it's double the trip, so the numbers are bigger. So it seems like it's more, but it's really not. The volatility has been less than normal recently.
Somebody in the room, I know who it was, I can't pinpoint him, and I probably shouldn't even if I could, but he was like, we've been working together for 25 years, and I know that there are some ups and downs. The worst thing that we can see is somebody bail in a downtime, and then they took the risk, but they did not get the reward. So you paid the price, but you didn't get the reward that you were entitled to for risking your capital, and it's so important. And we'll walk through an exercise with that too.
Well, I guess the thing I would like to say, kind of wrap up this slide, is you can see volatility has always been present in the market. It will continue to be going forward, and we expect it to happen. We don't know when it's going to happen, but we expect it, but we've planned for it. And that's why we've built the portfolios the way we have.
Yeah, so this slide really kind of begs the question of why would anyone put themselves through that kind of, sleepless nights or gut-wrenching downturns. And what this basically shows is, I think that this really hits the nail on the head. And it shows that the S&P 500, without counting dividends, went from it closed at the 1st of January at a level of 18. It closed at the end of 2015 at 2,043. I think it's somewhere around $1,850 today. I didn't see where it 1,850 points today. But here's what I do know, and this is really kind of key, is that anything that goes from 18 to 2,000, I just fail to see how you can lose money in anything that goes up 100-fold. How is that even possible? And the way it's possible is, and with all due respect, but here's the thing. Permanent losses in a fully diversified equity portfolio are a human achievement. They are not a market achievement. The market does not do that. We do it because we panic and we sell, and we sell and we lose. No panic, no sell, no lose. So it's just so crucial. These are the facts. That's what the market did. 18 to 2,000. It's not, capital markets have shown an incapacity to create permanent capital loss. They don't do that. That's not the nature of them. One thing that always helps me when we go through these periods of time, this is not going to give you a lot of confidence probably, but I personally, I'm a human being, and I just quit looking at my statement. I own the exact same portfolio that every person in this room owns, and I mean the exact holdings, except my portfolio is 80% in stocks and 20% in bonds. So you can imagine, I just don't want to look at it. I know what it's done. But I remember my number. And everyone in the room can go back and look at this, or we'll do it for you. My number is 72. I wasn't around in 1946. I was born on October the 4th, 1963, and at that time the S&P was at 72. And so I always try to remember that from 72 to 2000, man, don't be stupid, Brian. Follow your own advice. It's really kind of, it's really kind of as simple as that. I think there's a couple of other ways that we're going to try to portray the.
Yeah, so we can't predict the future. We can't make an investment plan based on this chaos theory, and so we've got to focus on the long term. Create a plan on that. This is a real good exercise to kind of show you what we mean by that. Does anyone know what this number represents? Anyone take a guess? It's a lot of money. It's a whole lot of money. $347 million. That's the amount. Yeah.
God, I wish.
That's the amount that Warren Buffett's shares of Berkshire Hathaway declined in one day on Black Monday on October 19th, 1987. One day. It declined $347 million. That's a lot.
That's a doozy.
So here's the quiz. What's the answer? You got it. Why? Because he didn't sell. Okay, so he had to go through that pain. I mean, that definitely wasn't fun. I mean, I've seen my 401k is invested in the same stocks you have. Mine's 100% stock, so I've seen a little pain. It was not $347 million. I wish it was. But, so what's the payoff by doing that? So that day, October 19, 1987, his shares closed at 3,170. It's gone up 62-fold since then because he held on. And you think, that's gone through 2001, 2002, 2008, just some horrible markets, some horrible days, some horrible times, and it's still up 62-fold. The S&P's up almost 10 times as much in that time frame. So that's why we're looking at long term. We see that it happens if you're there the whole time.
Dennis, I don't know if you can grab one of those books. Did everyone get the Buffett book that we were fortunate enough to write the forward to and maybe see the similarities?
Did you get one?
If you didn't get it, please take a copy. There's a lot. Look, we can't go in and make special deals with Goldman Sachs and get their preferred shares at 10%. In the decline of 2008, but there are a lot of similarities between our strategy and some of the concepts and principles that Buffett uses, not the least of which is sort of be brave when everyone else is scared, and when everyone else is feeling really brave and buying and buying and buying at these higher prices, maybe that's when we ought to kind of say, I don't know, that looks a little weird to me. So this is something that is really, really important that I wanted to cover today, and it's a notion that has been perpetuated by the financial media for so long, and it's so seductive, but it is so untrue. And I wanted to talk to you guys about it a little bit and see if maybe we can make some headway in it. And that is, the notion is the idea about, well, if I can just figure out where the economy's going, then I can kind of restructure my portfolio to take advantage of the zigs and zags in the stock market, right? Doesn't that sound like a good idea? It's false. And there's two kind of false premises to this really kind of cool sounding idea. Number one, as I'm sure I'm hoping you're starting to figure out, is that the economy cannot be forecast in the short to intermediate term. But secondarily, there's another false assumption, and that is, even if you could forecast the economy, then would we then be able to structure a portfolio to make a higher than market return and to get off like bandits? A lot of people think that we can. And the fact of the matter is, it's a wives' tale. It's just not true. And the reason that it's not true is that and maybe you've noticed, that the stock market and the economy are not correlated to any significant degree over except very, very long periods of time. I mean like 60, 70, 100 years. Stock markets tend to follow earnings over 60, 70, and 100 years. Well, who wants to follow that kind of pattern? Anyone in the room? Who's got another 70 years to make this work? I don't see very many people that are kind of going, yeah, sign me up for that. Let me give you hopefully a pertinent, maybe kind of a painful example. Again, the biggest stock market decline that everybody in this room experienced was in 2007 to 2009, and it was painful. The S&P 500 closed on March the 9th, 2009 at 676. Again, bump that up against where it is today. I don't know, it was 1800 or 2000, but it's a lot further than 676, okay? And let's just pretend that, John, you called me up that day and you said, you know what, sold a bunch of assets and I got a pile of dough. I think that this panic has got to be overdone. I think we ought to put this cash to work. But man, I think you're really smart, Brian. Can you tell me what I really got to know before I put this money at risk, what the economy is going to do. And go back to March of '09. I mean, a lot of people were feeling pretty nervous, hey? But this guy over here is Buffett. He's being brave when everybody else is scared. And okay, so this is purely make-believe. This is out of all space and time. This is not real. But when you called and asked me that question, I said, you know what, John? I actually know the answer to that question. Over the next 5 years, here's what's going to happen in the U.S. economy. It's going to grow at an agonizingly slow rate of like 1 to 1.9%. Many people are going to lose total faith in the leadership of our government. And unemployment's never going to get lower than 7%. And it wouldn't surprise me if you said, yeah, that's kind of what I thought. Why don't you call me again in 5 years? I'm not comfortable. I don't see the stock market gaining any traction in that kind of economic environment. 5 years later, this guy who had a dead perfect economic analysis and forecast over the next 5 years sat on the sidelines in cash and missed a tripling in equity values. And he was perfectly right. So the point I hope you would take away from this is, even if you knew what the economy was going to do, it wouldn't tell you what the stock market's going to do. It's not even going to tell you what it's going to do. And I hope you would also take away from this little story that, again, the media is not your friend.
And here's their favorite. We kind of beat this up a little bit, but there's a few points I want to hit about that. You know we can't time the market. And here's really why. It's even if you get it right and you get lucky and you get out at the right time. You were right once. Now you got to be right again. Now you got to be right when to get back in. And that's really the hardest part, because you have a conversation like that. I've got this cash now. Now when am I going to put it back in? Oh, the economy's not going to be good for 5 years. Never mind. And we've seen it time and time again. That's what happens, is that, okay, I'm out now. Someone will get out, and usually it's not the right time. It's after they've lost. So then they get out. The market runs up. Okay, well now what do? I sold them as low. Now it's up. You see it. Okay, well now I'm gonna get back in because the market's done well. Put their money back in, drops again. Now you've doubled your loss because you didn't stick in. And you made it even worse because you couldn't stick with that pain. And what it makes it even harder is that these changes happen quick and when you least expect it. When we've seen huge days happen really fast, and it's when you least expected that to happen. You didn't dream it would be, a 300, 400, 500 point increase when a week ago it was the end of the world. And if you miss that, then you're sitting there going, now what do I do? And there's been no one that can consistently time when to get in and when to get out.
Now somebody will get it right once, and then they'll bring in a lot of money as being the next guru money manager, and then they'll whiff it the second time. And then we lose a bunch of money. But really the point that Dennis is trying to make is, you look at these annualized returns of all these mutual funds or whatever, and they'll say it's done 10% a year, 8% a year, or whatever, or the market, even just market indexes. And the annualized return, whatever. That's not the way the returns happen. They happen, it's really, really messy, and it's really fast. It'll be bam, 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 and it'll go up like 15% in like 3 days. Or it'll go down 15% in 3, but the movement happens. It's not like, chink, 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 chink. I mean, that happens if you're sitting over at the bank and you're getting 1% a year. But that doesn't happen when we're over here trying to get, a rate of return over and above, over and above the bank. Which I suspect everybody in this room, that's what your objective is, or else you wouldn't be paying us to do it. So which really leads us to kind of the old maxim everybody's heard, you know, if you fail to have a plan, then you're planning to fail. And so what we've noticed by taking that a little step further is that those people that are acting pursuant to a written strategy as they're operating in the markets, that are acting pursuant to a logical strategy, you just have a better chance of having a successful investment experience. And those people that are reacting to the whims of the market, you know, tend to just feel like a kind of a, you know, a leaf on the water going, oh, I don't know where we're going. Maybe this is going to, you know, and it's just, so I wanted to get into a little bit, and we'll have to kind of speed it up now with the planning process.
So this is, we're going to say, you know, typical client here. It is from the John Cougar Mellencamp song, Jack and Diane.
Jack and Diane.
So
there's a little ditty about Jack and Diane.
That'd be about the right, how old are they in that song? So they've grown up, they've done well. So the client comes in, this is kind of the process we're going through. So they come in, they're 60 years old, both in good health, son that's 19, and enjoy loving, you know, they enjoy traveling. Where they're at now, so we sit down with them, you know, you've all been through it, where are you at now, where are you wanting to go? You know, what do you want to do? What's the money for? So they told us they've got $1.2 million in a trust, $400,000 in Jack's 401k, and $300,000 in Diane's 401k. So going through everything, what's important is that they'd like to reduce their savings so they can start traveling more right now. The next one is they want to pay for their son to get through MBA school. And then finally, they want to make darn sure that they have enough retirement income for the rest of their life without worrying about running out of money.
So this is just some data of what we have to work with these folks. They said, listen, ideally we want to quit right now. We don't know whether we can do that or not. We need you guys to kind of run the numbers and tell us what we can. And they were really totally happy in their careers. They were both making a really good income. And so they said, you know, to make everything work, we'd be more than willing to work another 5 years. Love to have $175,000 coming a year for the rest of our lives. $160,000 would be just fine. However, now like most people, they want an investment portfolio that has absolutely no risk and high returns. They were kind of kidding about that, but you know, we kind of said, well, I don't, you know, see what we can do about it. But they said, I do not want to go through again back to there. But I'm not going through another 2008. You know, but we can handle 15% to the downside. What kind of a rate of return do we, you know, do we need that kind of rate of return to achieve our goals? We said, hey, we'll go back to the drawing board and figure that out. Like most people, they had the way they did not inherit any of this money. They saved every penny, and they did that by spending less than they make and putting a little salt and a little bit aside, you know, every single month. So they had a couple $1 million, and they could leave that behind to their only son in their church. All right. But we talked about it a little bit further and said, well, for you guys to do all the traveling you want to do, let's say that you were able to send your son to at least full undergraduate with no student loans, if not MBA, would you be able to give a little bit on what you would leave behind in your estate? And they said, well, yeah, if we got him a good start in life like that, we'll leave him behind $100,000, no student loans, a great college education, that would probably work. So that gave us a little bit of flexibility on their savings goal. They wanted to reduce their savings so they could start traveling a little bit now, but they also said, listen, if we needed to ramp up our savings by about $800 a month or $10,000 a year, we could do that, and we will do that. So just you guys tell us what we ought to do. And travel is really important to this particular client. They'd like to have a $25,000 a year travel budget, but $15,000 a year, they could really do everything on their bucket list. Okay, so now we've got some pretty cool stuff to work with. Now we can go to work and start doing some scenario analysis and see what really makes the most sense for this particular client.
Yeah, so then what we do is we take all this data on when these cash flows are going to happen, how much is it going to be, then we can put it up against, well, what if we have it in this portfolio? We can see exactly what we've got in small cap stocks, international stocks, short-term bonds, long-term bonds. Well, we've got decades and decades and decades of data in all these. And so we can see exactly what has happened for, let's say, 50, 60 years. And then we run about 10,000 scenarios, taking all these different data sets and mixing them up to get what it's likely to look like going forward. It's never going to be exact, but with these 10,000 scenarios, we can see, you know, here's what could happen going forward What's the probability of this working? Or what if we make this change? What if, how does this look?
So this is the same methodology. When I first started out doing this stuff 28 years ago, this kind of technology wasn't available, at least at the individual level. But you guys have all seen how pension plans will come out and announce, this pension plan is, we see a lot of them now, underfunded. Or this pension plan is overfunded, or this pension plan is adequately funded. They don't just kind of, do this and say, yeah, let's just tell them it's adequately funded. This is what they do. They do probability analysis and using real long-term clean capital market data of here's what's in the pension plan. There's whatever, $10 billion in the pension plan, and we've got about a 50-50 stock bond split, and we got this much in international, and they run all these scenarios about, okay, we owe, I don't know, $7 million a year out to pay all the teachers their pensions for the remainder of their actuarially determined life, and that's how they determine whether they're adequately funded or not. So that we're just really, we're just kind of copycatting what the best pension plans in the world as far as their investment strategies and their financial planning strategies. And so over here on this side, this may sound kind of weird at an individual level, but if you kind of put on your pension you're the trustee of the Clay pension plan, and you've kind of hired us to be your co-trustee, okay? And so if you look at it like that, so we've got this amount of money to produce this amount of income for the balance of y'all's lives. You with me so far? And if we run that through this scenario analysis and we come back and we say, well, if those are your goals and your objectives and your dollars and your deadlines, listen, here's the thing. In 9,000 out of 10,000 scenarios, you end up with way more money than you needed. So that leaves you with some kind of cool options. You could reduce your investment risk and not see it bounce around so much. You could get a bigger life and spend more money. You could give more money away. I mean, there, it leaves some really kind of great conversations. On the flip side, I was going to let Dennis do the underfunded part because it.
Yes, appreciate that. Thanks.
That leads to the more difficult conversations.
You always get the fun ones. So yeah, they come back on this. Anything under 75%, that's the underfunded. Something's, in order to do what you want to do, something's got to give. And so that's when we start having the conversation and which one? Maybe you wait a few more years to retire, or you spend less for the next 5 years or 10 years, or we take more risk when it's probably most uncomfortable. And so then we can go through and run scenarios to look at, well, which one of these helps the most? Which one are you most comfortable with? And which one do you prefer? And hopefully get to this.
Yeah, so what we're wanting to find is balance. Somewhere between that 75% and 90%. I don't. For some reason, I don't latch onto those percentages, but we feel like that kind of gets you in the comfort zone where issues could be manageable, and it kind of serves as an early warning signal that hey, we need to have a difficult conversation with this client, or on this client over here. She's just over there living in this cruddy house, and she drives that car that breaks down all the time, and maybe she needs to really spend a little bit more. But getting you there but 75, 90% again, what it means is that in 7,500 out of 10,000 and 9,000 out of 10,000 future random lifetimes based on your goals and your objectives with real long-term capital market data with your portfolio, things tend to work out. So we kind of like to, I see this being so valuable at times like, I don't know if it's going to get into another 08, and I don't really think we're going to see another 08 in y'all's lifetime. I might see one in my lifetime, but I don't think most of the people in this room are going to see it in your lifetime. Sorry about that. I'm just kind of saying it like it is.
I'll see.
I think it's a once in a generation thing. But seriously, if you're worried about if you're okay, I mean, a lot of you people in the room entrusted all of your hard-earned money to us. And I don't think you should be sitting home saying, I wonder if I'm okay. This will tell you whether you're okay, so put us to work. And that's why we really wanted to kind of highlight this and maybe try to engage you in it, because this financial planning process can really help us say, yeah, you're fine. You can do it. Now, this is not curative. This won't cure. It's kind of like a financial MRI. If you're sick and you have cancer, well, that's what we have to tell you. Financially, you got a problem, and we got to cut out this and this and this. On the flip side, if you're okay, we'll tell you that. If you're overfunded, we'll tell you that. And we're going to be doing a lot of this stuff together. I see some folks in the room that we've kind of talked about this before, but this is sort of the way this financial planning process works, at least the way that we work it. So. And
this was huge in a year like 2008. I mean, here's a great example. There's a few times people came in. I mean, that was not. I don't think anyone in here was comfortable in 2008. I mean, it wasn't fun at all. People came in, and we'd done this planning, and I know we talked about we're going to take this trip, and it's going to cost $15,000. And look what our portfolio's done. There's no way. And we ran it, yeah, you were at 85 and now you're at 81. Take the trip, go. You're still okay. And that's the times that really helps. I mean, it's more fun when the market's way up and maybe you get to 90, but it's more important at the time. That helps us not focus so much back looking at that short term. We can look at, based on all those long-term expectation, you're okay. Go ahead and go take that trip.
So this stuff, once we get all this loaded up in here, and we've got a base plan for everyone in the room, we've got a updated plan for those of you that have engaged in this planning process with us, all of this can be updated into real-time numbers at any time. So it's something that once we get it going, it's pretty easy to maintain. So anyway, this is what we came back and recommended. I think you were going to do this part, Dennis.
Yeah, sure. So ideally, Brian went over their ideal and their acceptable. Here's what we'd like to have, and here's what we came back with. You see, the ideal, we went through and ran those 10,000 scenarios. It only worked out 23% of the time. Not going to happen. But then we looked at their acceptable, it worked out 99% of the time. And so this is when we sit down and go, okay, well now you got some options. And this is that, which one's more important? What do you want to do? And so, like, retirement income was number one. And so we said, okay, you can have that $175,000 a year, but you're going to have to work 2 more years. You don't have to go to 65, but you can go right in between. We can't do a no-risk portfolio, of course, but you told us you're fine seeing a 15% decline over a 12-month period. You don't have to take that much risk. You don't have to put yourself through that pain. You can do this with a mix that has a high probability it won't decline more than 10% over a 12-month period. So we don't, a lot of times it's based upon, well, I can take this much risk, then you get it. So they don't have to do that. They left an estate about half of what they'd like, which they're fine with. Could take their son through MBA school, and importantly, they got to drop their savings by $10,000 now and have that travel budget they wanted. So it worked out 82% of the time. And so that's what we've got going forward. That's kind of what we call it. Now we've got the base plan, and this is our starting point.
So this is the portfolio we ended up with, and this is how we used that financial planning process that we talked about earlier this week to map us to maybe a little bit more customized portfolio for each client. And I won't go through all this, but it's extremely diversified, owning like 12,000 stocks and bonds around the world. Very, very low cost at about 0.3% cost. 1-year risk of loss threshold, negative 10%. Probability of violating that loss over any 12-month period of time is about 6%. So, and one of the things I wanted to go over here, though, is annualized return since inception on this thing going back to 1970, net of all fees, 9.67%. Now, if we're going to get 9%, we know we're going to be taking some risk, and that's kind of the last thing, and I'm going to walk you guys through this just real briefly, but I think that this is really, really important. This is the 60-40 portfolio, and yours might be 65-35 or 70-30 or something like that, but I really kind of wanted to do a gut check with everybody in the room since we're going through a difficult time, and I did a little bit of math here, and this is going to be repetitive for some of you guys. You know I kind of like to hit the risk. But on this portfolio, you can kind of see that, so it averaged 9.5% for 46 years. But this is year by year by year by year, and you don't see hardly any years that came anywhere close to 9.5%, do you? There were only like 3 or 4. So to get this kind of rate of return, the returns are going to be messy. They're going to bounce around all over the place, as I said before. But let me just kind of walk you through 1970, and just kind of a little, because we will go through, I don't know if it'll be something like 1970, but we're going to go through another bear market. And think about what was going on in 1970. First of all, in 1970, a big news item was the tragedy at Kent State College. How many people remember that, where the kids were killed? Let's say that you became a Line wealth management client in 1970, and you invested $1 million in your portfolio. By the end of the year, all sorts of bad news, probably bounced around all over the place. You got 12 Schwab statements. Lost money, made money, lost money, made money, lost money. At the end of the year, you made 2%. Your million's now worth $1,020,000. How you doing? Are you running out to tell all your friends how brilliant we are? Probably not. You're probably going, yeah, I don't know. I think we probably should have made a little bit more money than that for all that. 1971, what happened that year was kind of cool. That's when the microprocessor was announced for mainstream distribution. How did that change all of our lives? And so that was a pretty decent year. And that year, the portfolio went up 21%. Now it's $1,234,000. How are we doing as a client? Pretty good? Stick around for a while now? All right. 1972. Things are starting to get kind of dicey there. We have Nixon. He gets caught breaking into the Watergate Hotel. It's not really looking too good. In spite of that, the market goes up 17%. Your portfolio goes up to $1.44 million. How are we doing? You going to stick around for a while as a client? Yeah. Okay. 1973 got pretty ugly. OPEC raises its ugly head. Now, today what they're doing is they're pumping out a lot of oil, I guess, to drive prices down. I'm not an oil guy, but that's sort of what I understand is going on. Back then, we had like these long gas lines, and they drove oil from remember, there's been a lot of inflation in the meantime, but OPEC drove oil from $1.50 a barrel to $11.50 a barrel in 1 year. Wow. The stock market didn't like that. Down 12%. Your portfolio went down from 1.4 million to 1.266 million. You're not looking at 1.26 million in all of my experience of doing this 28 years. You're not sitting there saying, I'm still happy because I went from $1 million to $1.2 million. Because all we remember is our high. Why is that? You lost $177,000, and that was probably more money than anyone's made in a year, at least back in 1972. And you're going, yeah, this is really bothering me a lot. And my wife is about to kill me. No, hang in there, man. We got Nobel Prize winners on our investment advisory committee. We got this killer thing to put together for you. We spent tons of time. Remember what we put together here? Well, in the next year, your portfolio went down another $181,000. Now you're at $1,085,000. Okay. Not only that, but let me see what did I find something that happened about. Well, I found something that happened there. I can't read anymore.
Need your glasses?
Oh, Nixon got impeached that year. And the other cool thing that happened, though, remember Evel Knievel tried to jump the Snake River Canyon.
And I was born that year.
Shut up, Dennis. Anyway, you get from 73 to 74, the media was pretty much all bad. Not even Evel Knievel could be the hero. He didn't make it over the Snake River. And, you got statements from Schwab or TD Ameritrade saying, I'm losing money, I'm losing money, I'm losing money, I'm losing money, I'm losing money. January, February, March, April, May. 1.4 million to $1,085,000. You've lost almost $400,000. How many people would have quit? Really? I knew we had the best clients in the world. This is awesome. If you had quit, we did you a disservice, because you see in 1975 the market, for whatever reason, went up 28.5%. Now you're back to $1,400,000.
That quick.
You're still kind of going, yeah, but that could go away pretty quickly. But in the next year is $1,666,000, and the next year is $1,009,000, the next year is 2.17, and by 1979 it was 2.35 million. But I would really kind of encourage you guys to go back and look at your investment policy statement that we've prepared for you. If you don't have it, please get with us, get into our office, or we'll email it to you or whatever. But I think it's a really helpful exercise to walk through and kind of say, we've been through this before. When we go into what, I'm not predicting anything, but it's so easy to forget, and it's so easy to be mired down in all the battery draining media into the world stuff and give up. And in spite of all that, if you're in a portfolio where you walk through that and you're like, yeah, that might have been right when we put that together 7 years ago, but I don't know that it's right today, and I don't really think I want to deal with that. We can tone back that risk level. And even though the market's not, it's down about now, it could go down a lot worse. So now might be a time to get more conservative. I'm not saying that's the right thing for you, but I'm saying, it's probably healthy to have an all new conversation that's never, out of the question. So we're here to help.
So once we get that, we do that exercise and get the plan going. It's not a set it and forget it kind of deal. And so Brian just went over how we have ups and downs. So there's a few things that reasons why we want to continue to monitor this. One is it's going to change as time goes because of the fluctuation of your investments. And so we'll pay attention to, are you still on track? Are you still on track? What's going on with that? So that changes as we go. So we want to monitor that. But more importantly, what and what we see is your life changes along the way. Things happen. You change, the goals change, the time frames change. Some surprise shows up and maybe completely throws it off and it changes it all and we need to start over again. And so a lot of you really use us quite a bit on this. We maybe at 85% and call and say, okay, we're moving, we're looking at this house and one of them's 500,000 and one of them's 300,000. What happens if we buy the 500? What happens if we buy the 300? How's our plan look? And we go run that. What if we mortgage half of it, or what if we pay cash for both, or whatever it is, and we can come out and say, okay, if you want the $500,000 one, you're gonna have to cut your income by $20,000 a year, or just all these scenarios, or what if I'm gonna do that, what if we do this earlier? And so we can go through and run that and let you can go make decisions with some, I won't say it's complete certainty, but more comfort. And that it fits with your plan, you're going to be okay doing that. And that's really what we've seen a lot of people get out of doing this.
I found this just yesterday, and it was really kind of shocking. I mean, I don't know if you guys have noticed this presentation or how these come about, but every time that we have one of these, we start trying to figure out, we just start grabbing what we think is decent data from all over the place. But just yesterday, I thought we had the whole, program put together for today, and this came across my desk, and it was a survey of like 4,500. It looked like a statistically relevant survey, and it just totally blew my mind, because what it said was, the question was, what do you fear the most? And 80% of people feared running out of money more than they feared death itself.
40-year-olds, no less.
And I was just like, man, that is just... So please, put us to work on this plan. I mean, there's a lot of people in the room that have no fear of running out of money, but I see some people in the room that you may be kind of going, well, I worry about that. Well, I'm not saying that this planning process will tell you everything's hunky-dory and okay. I mean, those of you that have worked for us long enough know that we're just going to tell you the plain, unvarnished truth all the time, to the extent that we're given light to see the truth. But this planning will tell you where you stand. And a lot of times, if you have understanding, you get rid of the fear and start taking appropriate action. So please put us to work if you have that notion, because I was like, God, you shouldn't be worrying about running out of money. I mean, we ought to at least do a plan and figure it out. So anyway, we really appreciate you guys coming. Sorry we ran over a little bit of time today. I hope that this was I hope that this was helpful and interesting, and I just appreciate all you guys. Thanks for your continued trust and confidence. It may get rougher. We will be with you guys every step of the way we always have been, and put us to work. So thank you very much.
Thank you.